Why is a currency peg hard to maintain in economics? Imagine trying to keep a ball perfectly balanced on your finger while the wind keeps pushing it in different directions. That's similar to what managing a currency peg feels like. A currency peg, or fixed exchange rate, is when a country's government or central bank sets a specific value for its currency against another major currency like the US dollar or the euro. The goal is to keep things stable, make trade predictable, and reduce sudden currency swings. But keeping that peg steady over time is a real challenge. To do this, the central bank has to actively buy or sell its own currency in foreign exchange markets. If demand for the local currency rises above the fixed rate, the central bank must sell its foreign reserves to prevent the currency from appreciating too much. If demand drops, it needs to buy its own currency using foreign reserves to stop it from depreciating. This constant buying and selling can drain a country's foreign reserves quickly, especially if the market moves against the peg. Countries with limited reserves find it even harder to keep up, making the peg fragile. Another big issue is that a fixed exchange rate ties a country's monetary policy to that of the anchor currency. If the US Federal Reserve raises interest rates, a country pegged to the dollar might have to follow suit, even if its own economy doesn't need higher rates. This can cause problems like high unemployment or low growth because the country can't set its interest rates based on its needs alone. It sacrifices control over its own economy to maintain the peg. External shocks also make maintaining a peg tough. Sudden changes in global markets, like a drop in commodity prices or a financial crisis, can cause large capital flows in or out of the country. If investors lose confidence and start selling the local currency en masse, the central bank must spend huge amounts of foreign reserves to defend the fixed rate. Sometimes, these pressures are so strong that countries are forced to abandon the peg altogether, leading to sharp devaluations and economic instability. Inflation differences between the pegging country and the anchor country can also cause trouble. If the local country experiences higher inflation, its goods become more expensive compared to the anchor country's goods. This makes exports less competitive and can lead to trade deficits. To fix this, the country might need to adjust the peg or devalue the currency, but frequent changes can undermine the stability the peg was supposed to provide. Political factors add another layer of difficulty. Maintaining a peg often involves unpopular measures like raising interest rates or implementing austerity. Governments face pressure from different groups. Exporters want a weaker currency to boost sales, while consumers and borrowers prefer lower interest rates. Balancing these conflicting interests can be politically risky and make it hard to keep the peg in place for the long run. There are different types of pegs, like hard pegs that fix the rate rigidly, soft pegs that allow some fluctuation, crawling pegs that adjust gradually, and basket pegs tied to a mix of currencies. Each has its own set of challenges. For example, a hard peg requires constant intervention, which can be costly and unsustainable. Soft pegs give more flexibility but still need occasional adjustments. Most countries today prefer floating exchange rates, where the market determines the currency value. Pegs are more common among smaller or developing economies that want stability. But even these countries often face pressure to abandon their pegs during crises. The decision to keep a peg involves weighing the benefits of stability against the costs of losing policy flexibility, depleting reserves, and facing external shocks. Understanding why currency pegs are hard to maintain helps explain why many countries eventually switch to more flexible exchange rate systems. It shows how complex managing a fixed rate can be, especially in a world where markets and politics are always changing. While pegs can offer short-term stability, their long-term success depends on a country's ability to manage reserves, align policies, and withstand external pressures.